Let's talk about Fed policy itself. So I'm looking at today's data, for example. So today's news, non-farm payroll growth revised down by 818,000, according to the Labor Department, a magnitude not seen since 2009 in terms of a downward revision. It says here the BLS said the actual job growth was nearly 30% less than the initially reported figure last month. So how is this going to impact Fed policy at all? Keeping in mind
It's
that
not going to impact Fed policy at all. And the reason why that is because basically these revisions were known. We could go down the rabbit hole of talking about QCW revisions, but the gist is that that every year there is a revision. This data is for April of 2023 through March of 2024, so it's very stale and old. It's not reflected or influence. It doesn't influence the printed unemployment rate because that comes from a different survey. And the big picture is like during that period, employment was pretty good, getting, something like 175,000 jobs a year or a month for an economy that, whose natural rate of employment growth is probably, and labor force growth is probably closer to 100,000. So we went from a very strong job market to a, decent job market based upon those revisions. And those people who follow this closely, we already saw signs of this revision happening in previous quarters. And so this is a very incremental piece of information. And the markets took it that way as well, in the sense that markets didn't meaningfully move on the news.
Oh, well, forward looking then, can you give us some guidance in terms of how the labor market can progress or evolve from here? 4.3% was the latest unemployment reading. Is it going to take higher, Bob, do you think?
Well, I think we're in a process of gradually slowing economy as interest rates have been elevated for an extended period of time. But that slowing is very gradual. The unemployment rate shift is probably the weakest indicator of any indicator, whether in the labor market or the broader economy, and partially overstated by the fact that it was driven up by a substantial amount of new entrants as well as temporary job layoffs. And so we're unlikely to see an acceleration at the pace that we've seen in the last couple of months that were influenced by those sort of transitory or one-off factors. Much more likely, what we'll see is a gradual meandering up of unemployment very slowly and a gradual slowing of GDP. But at a big picture level, this is not an economy that, if you have an economy that's growing in a real basis at 2 to 3%, and you have inflation that's still at 2 to 3%, and you have stocks at all-time highs and spreads at all-time lows, that's not a combination of dynamics that is consistent with 200 basis points of Fed cuts in the course of 12 months. It's totally inconsistent with that.
Okay, so you think the markets are too aggressive in pricing in how many cuts we're getting. So how many do you think we are going to get realistically going into next year?
Well, if you're trading markets, the question isn't necessarily you don't have to pick your cuts precisely. But what I'd say is I think it's going to be a pretty slow process. We're talking about a handful of cuts through the course of the next 12 months. Nothing like, I guess, the 8 25 basis point cuts that are priced in. And certainly, if you even just look at the September numbers, the market pricing today is still for something. It's about a 60-40 on 50 basis point cut. If you look at the Fed minutes that were released today, nothing indicates that there would be a move for 50 basis points. You would have to see an incredible weakening of the labor market in the one print that we have between now and September to get anything close to that. It seems highly improbable that you would get 50 basis points of cuts given what we're seeing comprehensively with the labor data.